Let's look at what happens when a PMCC trade goes wrong and how to recover. This trade was entered when the stock was at $82.35. We bought a 75 leaps call and sold an $88 call with a net cost of $11.16 per share. We collected $1.29 in premium, bringing the adjusted cost down to approximately $9.87 per share. Now the stock drops to $70. This is where most traders get uncomfortable. The $88 short call is now deep out of the money, so it expires worthless. You keep the $129 premium. But your leaps is now out of the money. At $70, it has zero intrinsic value and is worth about $4, purely from time value. So your position drops from about $9.87 cost to $4 value, which is an unrealized loss of roughly $587. Let's compare the two positions. If you own the stock directly, your loss would be over $1,200. The PMCC cuts that loss by more than half. That's the built-in downside cushion.
But now the strategy changes. This is no longer an income trade, it becomes a recovery strategy.
You start selling closer calls. For example, a $75 call for about $1. This reduces your cost basis from $9.87 to about $8.87. Over multiple cycles, premiums add up. Recovering around $3 per share brings your cost down closer to $6.87. But there's a risk. Your leaps is now weaker, lower delta, no intrinsic value, and time decay is working against you. When the leaps goes out of the money, PMCC shifts from income to recovery. Your focus now is reducing cost, managing risk, and deciding when to continue or exit.